All right, welcome to AI Explains ICT. This is episode 2, and we are jumping straight into the deep end with the 2022 model. Episode 1 was just a quick hello, but this is where the real lesson starts. We're going to really break down this amazing trading blueprint.
Now, a lot of people will tell you the 2022 model is one of ICT's most straightforward concepts. And it is. But don't let that simplicity fool you. It is absolutely packed with powerful insights. So yeah, I would seriously recommend grabbing a notebook because you're going to want to jot some of this stuff down and really figure out what parts of this model click with your own trading.
So, here's our game plan. First, we're going to lay out the core blueprint of the model. Then, we're going hunting for liquidity and learning how to spot that critical market structure shift. After that, we'll nail down our entry, see the whole thing play out in a real trade, and finally, I'm going to give you your mission to go out and prove this to yourself. All right, let's get into it. First things first, we have to start with the fundamental idea. You have to understand that the market isn't just random noise. The core teaching from ICT is that it's all driven by very precise algorithms. And this model, it's basically our decoder ring for seeing the logic behind the price action. To really get this, we have to do something that's, well, it's kind of tough. We have to look at the chart with fresh eyes. ICT says it perfectly right here. Strip away everything else that you want to bring to the conversation. For real. For the next few minutes, forget everything you think you know. Forget about support and resistance. Forget about trend lines. All of it. We're starting with a completely blank slate. So what are we looking for with these fresh eyes? The big idea is that these high-frequency trading algorithms are running the show every single day. And when they operate, they leave behind little clues, repeatable patterns. ICT calls them algorithmic signatures. Our job is to become detectives, to train our eyes to stop seeing chaos and start seeing these very clear, very distinct signatures.
Okay, now let's build on that. The very first and maybe the most important building block of this entire model is liquidity. You got to think of liquidity as the why. It's the fuel that makes the market move. It's the reason for almost every major swing you see.
So what the heck is liquidity? Well, in the simplest terms, it's just a giant pile of orders. Just think about it, right? Where does everyone put their stop losses? Just below an old low. Where do all the breakout traders put their buy orders? Just above an old high. It's human nature. And these obvious pools of orders become a huge magnet, a target that the algorithm is specifically engineered to go after.
And this chart shows it perfectly. Look down at that level marked sell-side liquidity. That's just a huge collection of sell stops sitting there, waiting. Now look up top at buy-side liquidity. Same story, just a cluster of buy stops. The algorithm's main job, a lot of the time, is to run the price to one of these zones, trigger all those orders, and then look for a reason to reverse.
Okay, so if liquidity is our why, then the market structure shift, or MSS, is our when. This is the signal. This is the tell that lets us know the market might be about to change direction. But, and this is so important, it only becomes a meaningful signal after that liquidity has been taken.
Let's get really specific about what this looks like. For a bullish shift, you'll first see price dive below an old low to grab that sell-side liquidity. Then, immediately after, you'll see an aggressive rally that breaks a recent short-term high. That break of the high is our market structure shift. The sequence is everything. Liquidity grab first, then the shift. That's what makes it so powerful.
And this brings up a little bit of important vocabulary from ICT. He makes a distinction between a shift and a break. A market structure shift, which is our focus, signals a potential intraday move. It's a short-term thing. A market structure break, on the other hand, is a much bigger deal. That suggests a major change in direction that could last for days. For the 2022 model, we are laser-focused on finding these smaller intraday shifts.
Okay, let's recap. We have our why, which is the hunt for liquidity. We have our when, which is spotting the market structure shift. So what's left? We need the where. This next part is all about pinpointing our exact entry zone with precision.
And this is the key question, isn't it? After we see that shift, the market has basically shown his hand. It's told us, hey, I'm thinking about reversing. But the million-dollar question is always, okay, great, but where do I actually get in? Where's the spot with the best risk to reward?
Well, our first tool for finding that spot is the fair value gap, or FVG. It's a simple three-candle pattern that leaves behind an imbalance, a little pocket of inefficiency where price moved way too fast in one direction. And these gaps, they act like magnets. The algorithm loves to bring price back to these zones to rebalance the books, which makes them a fantastic place to look for an entry.
Our second tool is the order block.
Now, in the world of ICT, this is more than just the last down candle before a big up move. It represents the specific point where the algorithm's programming flipped. He calls it a change in the state of delivery. It's the origin point where the market switched from selling to buying. And just like an FEG, price is often drawn back to retest this level.
All right, that's enough theory. It's one thing to talk about these concepts, but it's another thing to see them work. So let's see how all these pieces come together in practice. We're going to walk through a real trade example from ICT and watch the 2022 model in action, step by step.
Okay, let's break down the setup on this chart. First, notice a bullish market structure shift has already happened. That's our confirmation of a potential reversal. Now we see price pulling back into what ICT calls a discount. That just means the lower, cheaper half of the recent up move. And where's it heading? Straight for that fair value gap. This is the A+ setup we've been waiting for.
And here comes the execution. As soon as price trades down into that green shaded box, into the fair value gap, a market buy order is placed. This isn't random clicking. It's a precise, planned entry, reacting to price returning to that key level of imbalance we identified ahead of time.
So where are we aiming? The logic is so simple and so powerful. We bought low in a discount area, so we are going to sell high in a premium area. Our objective is what ICT calls the low-hanging fruit. In this case, the most obvious pool of buy-side liquidity just sitting there on the other side of the move. We're not trying to be a hero and catch the absolute top, just the highest probability part of the move.
And the result of that single trade, just from following this model, step by step, a profit of $1,190. This is a powerful demonstration of what happens when you stop chasing price and start waiting patiently for these specific algorithmic signatures to appear.
Now, watching me talk about this is one thing, but the real learning, the kind that truly builds confidence, only happens when you see this for yourself. So this last section is your mission. It's time to go into the charts and prove to yourself that this pattern repeats over and over again.
ICT himself said it best. My goal here isn't to convince you of anything. You have to convince yourself. And you will, once you start putting in the work and seeing this pattern for yourself. As he says, once you truly see it, the argument is over. There's nothing left to debate.
So here's your homework, your actionable framework. 1. Start on a 15-minute chart and identify the obvious liquidity pools. 2. Drop down to a lower time frame like a 1, 2, or 3-minute chart. 3. Wait patiently for price to run that liquidity. 4. Identify the market structure shift that follows. 5. Find the fair value gap or order block that gives you an entry. And 6. The most important step, log every single example in a study journal. This is the work that builds true mastery.
We really hope this detailed breakdown of the ICT 2022 model was helpful. If it was, please do us a favor and hit that like button and subscribe to the channel so you don't miss our next video. And if you have any questions or suggestions for what we should cover next, drop them in the comments below. We read all of them, and a real human will get back to you.
Until next time, trade safe out there.